I will start with the question first. Since today our topic is on market outlook, right? So my question is very simple, Sani. I believe a lot of people also ask you about this. And my question is this. What is your outlook about the market?
Right. Okay. The million dollar question. Although nowadays no one talks about in terms of million. It's always now in terms of billion or even trillions. So anyway, the outlook question has always been the toughest, of course, to answer. Even more so in this kind of environment. Maybe before I answer the question, I need to explain a little bit about how I formulate my views on where I think the markets are going, because it may be different from some other people. I always feel, and I think a lot of, when you read some investment books, they will tell you that it is not a binary decision, which is a 1 and 0. If you think market's going up or you think market's going down, it's not as simple as that. Basically, you try and attribute a probability to what you think or where you think the market's going. Meaning to say that currently today, based on what I know about the markets, based on my assessment of the markets, I, for example, believe that there is a 70% chance of market actually going down from here and a 30% chance of market going up. So basically then, behind these numbers, I have my reasoning why I think so and so on and so forth. So basically the outlook is always a probability. And therefore, thereafter, you mold your strategy based on that probability. Because today I hear a lot of people either deciding to stay out because they think the market's going down, or to go all in because they think the market's going up. Basically, you only do that if you think it's 100% probability. Yeah. So the next time someone tells you that I think the market's going up or the market's going down, what I would advise you to do is ask the person, what probability do you think that event will happen? So if he says, I'm very sure, then ask him, do you have 100% of whatever you have in the markets? Because again, when you have a probability tree, meaning to say 70-30, your investments ought to be reflective of that probability, meaning to say, for example, 70% in bonds, 30% in equities because you think so, and so on and so forth. Yeah. So again, the outlook, again, as I mentioned, 70-30, 70% to the downside, 30% to the upside. And I have my reasons behind it. And I think probably we will probably go through these reasons later on, and I can explain them in more detail. But the outlook is a slight bias, more to the downside than to the upside at this particular point.
Okay, Sani, I mean, maybe it's also good to let the audience know about how we actually manage our so-called portfolio, because as you know, probably we need to also let the audience know that the way that how we actually look into a portfolio is not short-term, it's long-term. So probably you want to probably explain to the audience about the methodology and how we view about our portfolio.
Yeah, that's a good point, because I think people have to have the correct frame of mind. When I say something, then it has to be put into the context of that. Okay.
Right. Yeah.
Because we are a financial advisory firm, most of the time when we meet people, we are talking about financial objectives. And these financial objectives are very long-term. Either someone who wants to retire in 20, 30 years' time, someone who wants to prepare his or her child's education in 10, 15, 20 years, and so on. So a lot of time we help these clients reach their objective by formulating a portfolio which matches the client's risk profile, and try and guide this client through the journey from now point A to point B in a manner whereby it is comfortable for the client. So basically, it is a long-term journey. The portfolios are not the typical in and out portfolios, because when you're investing long-term, you don't go in 100%, go out 100%. What you try and do is you try and ride through the cycles because markets actually go up and down. And you try and what we call mitigate and lower the volatility so that the client doesn't suffer this kind of large swings, either up and either on the way down. Yeah. So you want to have a smoother type of journey for the client so that he reaches his destination with a good return. But the journey is important. Because sometimes when you allow clients to sit through very sharp ups and sharp downs, after a while, it's very tiring, emotionally draining and stuff. So our work or our duty, our responsibility is to try and get the client to sit through the whole journey in a comfortable manner. So again, the way we manage money will be totally different from someone who says a short-term guy, or maybe even less than 5 years, or even worse, less than a year. Then a different mentality sets in. a trader will be in, out, trying to catch the bottom, sell the top, and so on. And someone who is a medium term up to 5 years may be a bit different, and someone like us longer term will be a bit more different. So there are different strategies, and people need to understand that, because it's not, people tend to think always it's just about coming out when you think the market is going down and going in when you think the market is going up 100%. No, it's not actually like that.